Stop what you're doing right now at this very moment. Something is happening in the silver market that hasn't happened in years, maybe decades. The kind of convergence that doesn't announce itself with a headline. The kind that most retail investors completely miss until the move is already over and they're left asking, why didn't anyone tell me? Well, someone's telling you right now. Silver spot is sitting at $88.50 on Western markets. Gold is at $5,228. 2 trading sessions ago, just 2, both metals were meaningfully lower. Over those 48 hours, gold has climbed roughly 4%. Silver, over 11%. Bitcoin, in that same window, is down. Let that sink in. While crypto is bleeding, while tech stocks are crumbling, while AI disruption is wiping tens of billions off the market caps of cybersecurity giants in a matter of days, silver is absorbing every attempt to knock it down and coming back stronger each time. Today alone, silver got slammed to an $85 handle more than once. Both times, it recovered. It is now sitting at $88 or $50 and holding. That is not a weak market. That is a market where the real bids, the physical, structural, fundamental bids, are sitting underneath like bedrock. Someone wants this metal, badly, and they're not going away. Tonight, for the first time since Lunar New Year, the Shanghai Futures Exchange reopens. We mapped this moment in the last video. Now it's here. And everything we talked about, the naked shorts, the paper versus physical tension, the delivery demands, it all comes to a head starting tonight. This video is going to cover everything: price structure for those learning technical analysis, the physical supply and delivery situation at COMEX, the massive forced short position on the Shanghai exchange, the Mexico supply risk, macro tailwinds from tariffs, geopolitics, and AI labor disruption, Chinese capital flows, the gold to silver ratio, and the honest, unflinching case for caution, because hype without balance isn't analysis, it's entertainment. What the price is telling you right now. Silver spot, $88.50, Western silver futures, $88. Shanghai spot came in at $86. Shanghai futures, $88. The price structure across both Eastern and Western markets is converging, and what's happening intraday is telling a very specific story. Multiple suppression attempts today. Price got pushed down to the $85 handle. Not once, but more than once. And more than once, it came back. This is not random. When a market gets hit, holds, and recovers repeatedly, the technical message is clear: sellers are running out of fuel. The bids underneath are absorbing the pressure. The path of least resistance is shifting. Now, for those of you learning price structure and how professional traders read tape in real time, what follows here is strictly educational. This is not a signal, not advice, not a call to action. This is a walkthrough of what to watch and why it matters. In the previous video, we clearly mapped out the resistance zone sitting between $87.20 and $89. Price is currently inside that zone. We have not yet seen a confirmed hourly body close above it. That distinction matters enormously. A wick above resistance, a momentary spike that gets rejected, is very different from a full candle body closing above it. Wicks are tests. Body closes are confirmations. Institutions don't chase wicks. They wait for body closes. They want to see that the zone has been converted from resistance into support before they commit full size. What this market needs, if the bullish structural thesis is going to play out, is a decisive hourly body close above $89. Not a spike, not a flash print, a body close. Once that happens, the next structural level is $90, then $92. And above $92, the door opens for a serious continuation move. Until that body close confirms, the zone is still doing its job. Shorts can reload inside this zone. They have time. The battle is not yet won. Watch the hourly. Watch the body. That's the education. And if you're learning and finding value in this breakdown, drop OG John AG in the comments. 3 words. I'll know who's actually paying attention. The COMEX delivery situation and why it matters. Here's where it gets structural, and this is the part most mainstream financial media completely ignores. Silver's COMEX implied volatility index has broken above 100 again. Think of this like the VIX for silver options. When it's low, options traders expect calm, relatively predictable price movement. When it spikes above 100, the options market is pricing in potentially violent, disorderly price moves ahead. It doesn't tell you direction. It tells you the structure underneath is under stress. The players who trade options for a living are hedging for chaos. Now let's talk about why that stress has a very specific, identifiable source. March silver open interest, with just 3 trading days until first notice day, is sitting at 44,500 contracts. Each COMEX silver contract represents 5,000 ounces. Do the math. That's over 223 million ounces of paper silver still open heading into first notice day. To give you context, total global silver mine production in an entire year is roughly 800 to 850 million ounces. We have paper contracts representing more than a quarter of global annual production sitting open days before they have to either roll, close, or stand for physical delivery. Now, in normal market functioning, The vast majority of these contracts will roll into future months or close without ever triggering a delivery demand. And that's how the paper commodity market operates. Most participants are speculators or hedgers. They're not there to actually pick up silver bars from a warehouse. But here's the pressure point. Every contract that does not roll becomes a delivery demand. And COMEX February silver deliveries have already hit 23.5 million ounces this month alone. The physical delivery pipeline is not theoretical. It is active, it is running, and it is putting real pressure on physical inventory. And then there's what's happening to that inventory in real time. On Friday alone, 2.25 million ounces were drained from COMEX silver warehouses. This wasn't a single custodian. Withdrawals came from CNT, Delaware Depository, HSBC, and JP Morgan. 4 separate institutions pulling metal out on the same day. Total COMEX silver inventory now sits at approximately 364 million ounces. The drain is not slowing down. The physical silver is leaving the building. When physical inventory declines while delivery demand is elevated and paper open interest hasn't meaningfully collapsed yet, you have a compression setup in the making. The paper price and the physical reality are in tension. That tension gets resolved eventually. It always does. The question is timing and magnitude. The Shanghai short and tonight's reopening. Now let's talk about the elephant in the room, or more accurately, the naked short on the Shanghai Futures Exchange. We covered this in detail last video. But for new viewers, here's the situation in plain language. There is a Chinese billionaire, a well-documented name in this story, holding a short position on the SHFE, representing approximately 450 metric tons of silver. To understand why that number is so significant, you need to know that total physical silver inventory held on the Shanghai Futures Exchange is approximately 350 metric tons. Read that again. The short position is larger than all the physical silver sitting on the exchange it's traded on. This is what's called a naked short at scale. In theory, a short position of this size would normally require either physical silver to deliver or a credible ability to source it. At 450 metric tons against 350 metric tons of exchange inventory, the math doesn't work cleanly. There is no physical buffer. Regulators have already responded. They've frozen this position holder's ability to add new short contracts. They've raised margin requirements. The pressure is on. Can he hedge through other markets? London, COMEX, OTC? In theory, yes. But at this scale, with cross-exchange capital requirements and no physical buffer on the exchange where the position lives, the exit path is not clean. This is not a small fund quietly rolling a position. This is a structural problem playing out in public, in real time. The SHFE was closed for Lunar New Year. It reopens tonight. Here's what that means. During the holiday closure, Western silver prices moved significantly. Shanghai spot was at $86 when it closed. Western prices ran higher. When the SHFE reopens, Chinese market participants will need to price in that gap. How they respond to that gap, aggressively, cautiously, or somewhere in between, will be one of the most important data points we get in the next 24 hours. If Chinese institutions see that gap and move to close it, buying futures, closing shorts, taking physical, the upward pressure could accelerate quickly. If they respond with caution, the move may be more measured. Watch the overnight open. Watch the first hour of trading. That reaction will tell you a great deal about where institutional sentiment sits on the eastern side of this market. Mexico, cartels, and the supply risk. Let's talk about supply. Specifically, where a significant portion of it comes from and what's threatening it. Mexico is the world's largest silver-producing country. It accounts for roughly 1 in 4 ounces of silver mined globally. For the United States specifically, Mexico supplies approximately 45 to 50% of silver imports. That is not a diversified supply chain. That is a single point of significant geographic and geopolitical concentration. And right now, Mexico's mining regions are under serious cartel pressure. The situation has been escalating. Roads leading to key mining operations in affected regions have been blocked. Mines have paused or halted operations. Cartels are extorting shipments. The security environment for mining companies operating in these areas has deteriorated sharply. What's new, and what matters for the geopolitical dimension of this story, is the U.S. response. President Trump publicly stated, in plain language, that if Mexico wanted help dealing with the cartels, the United States would be, quote, honored to go in and do it. That is not a diplomatic back-channel comment. That is a public on-record statement about potential U.S. military involvement in Mexican territory. Whether that materializes or not is secondary to what it signals. The situation has escalated to a point where the American executive branch is openly floating military intervention in the country that produces 1/4 of the world's mined silver. That level of geopolitical entanglement around a critical industrial metal is simply not being priced into paper markets right now. Here's the honest caveat: the cartel disruption risk is real and directionally concerning, but it has not yet shown up in confirmed mine output data. The supply disruption risk exists on paper. Whether it translates into a measurable reduction in physical silver flowing to market is still an open question. We don't yet have confirmed production data showing a supply shortfall from Mexico. We have escalating risk, not confirmed impact. Watch this space carefully. The difference between risk and confirmed disruption matters enormously for how you think about this factor's weight in the overall thesis. The structural supply-demand reality. Whether or not Mexico disrupts, whether or not the SHFE short gets resolved cleanly, the underlying supply-demand fundamentals for silver are the most strained they've been in the modern era. Here's the baseline. Global silver mine production peaked in 2016. That wasn't last year. That was almost a decade ago. And critically, current production forecasts don't project a return to that peak level until approximately 2030. We are in a multi-year production trough relative to where we were at peak. Meanwhile, demand has structurally transformed. Not long ago, industrial uses accounted for roughly 47% of total silver consumption. Today, that figure has climbed to approximately 67%. The growth drivers are not speculative. They are physical, embedded in the global economy, and accelerating. Solar panel manufacturing, electric vehicles and their charging infrastructure, data centers and AI server farms, defense electronics and advanced weapons systems, medical devices, consumer electronics. Every one of these sectors uses silver, not as a store of value, not as a speculative trade, but as a functional industrial input. And every one of these sectors is growing. Solar alone deserves a closer look. The global push toward renewable energy, driven by policy mandates, economics, and corporate sustainability commitments, has resulted in solar panel installation growing at rates that most forecasters dramatically underestimated just 5 years ago. Silver is not replaceable in solar photovoltaic cells without a meaningful efficiency penalty. Thrifting efforts, reducing the amount of silver per panel, have helped, but demand growth has outpaced thrifting by a wide margin. EVs add another layer, not just the vehicles themselves, but the charging infrastructure. Every rapid charger, every connector, every thermal management system has silver in it. AI infrastructure, the data centers running the large language models and cloud compute that everyone is talking about, requires massive amounts of copper, but also silver for high-performance connections and specialized components. As AI compute demand grows, so does the physical hardware footprint. So does silver demand. The result? The silver market has run supply deficits for 5 consecutive years. 5 years in a row where demand has exceeded what mines and recycling have been able to supply. Those deficits have been drawing down above-ground inventories. The buffer is thinner than it's been in decades. Paper pricing has not reflected this reality. The price of silver on futures exchanges has not caught up to what the physical supply-demand balance actually looks like. That gap between paper price and physical reality is the core structural tension driving everything we're watching right now. Macro tailwinds, tariffs, geopolitics, AI disruption. The structural silver story doesn't exist in a vacuum. It's playing out against a macro backdrop that is, in almost every dimension, favorable to hard assets and hostile to paper ones. Let's walk through the layers. Trade war escalation. The tariff environment is not calming down. The latest development involves Trump threatening significantly higher tariffs against the European Union in response to the EU's move to freeze ratification of a trade agreement following a U.S. Supreme Court decision. The framing from the U.S. administration has been explicit and aggressive. The U.S. will hit harder than before if trading partners try to play games. This matters for global capital allocation. When the world's 2 largest economic blocs are engaged in escalating trade disputes, uncertainty increases. Businesses delay investment decisions, supply chains get restructured, currency volatility rises, and historically, not as theory, but as observed market behavior, periods of significant trade tension push capital toward assets that don't carry counterparty risk. Gold, silver, physical assets you can hold. Middle East geopolitics, U.S. military hardware in the Middle East remains at elevated positioning levels. The situation with Iran has not been resolved, it has paused. And pauses with that level of forward military deployment don't always stay pauses. The market has largely stopped pricing an escalation risk because the escalation hasn't materialized yet, but the structural position remains. A sudden escalation event in the Middle East would send immediate shockwaves through energy markets and simultaneously drive capital into hard assets. This is a tail risk that is currently underpriced. The AI labor disruption layer. This one connects to the metals thesis in a way that most market commentators haven't fully traced through, so stay with me here. AI is not failing. It is working, but it is working faster than the traditional labor economy can adjust. This week, Anthropic launched Claude Code, an AI tool capable of writing, debugging, and converting complex code autonomously. The downstream market reaction was immediate and significant. Cybersecurity stocks lost over $52 billion in market cap across just 2 trading sessions. CrowdStrike fell 20%, Cloudflare dropped over 18%. IBM fell 10% on the specific news that Claude Code can directly convert legacy COBOL code, which is exactly the kind of high-margin, specialized modernization work that IBM has built a major revenue stream around. These are not small moves. These are large, established companies losing a fifth of their market value because the market is pricing in AI-driven displacement of their core business models. Now, trace that thread further. White-collar workers, software developers, security analysts, financial professionals, legal researchers, code modernization specialists represent roughly half of U.S. employment. And critically, the top 20% of income earners drive over 60% of total consumer spending in the United States. If AI tools systematically reduce the cost of tasks historically performed by high-income cognitive workers, and if that displacement happens faster than new high-income roles are created, you get a wage-based demand contraction. That contraction feeds back into housing prices, consumer credit performance, tax revenue, and government fiscal balances simultaneously. This is not a prediction of collapse. It is a logical sequence of cause and effect that is worth tracking carefully. And it creates a specific macro environment, deflationary pressure on labor income, which increases pressure on fiscal deficits, which increases pressure on the dollar, which increases demand for assets that cannot be printed or inflated away. That is the environment where metals are designed to outperform. There's also what you might call the AI displacement loop. AI improves, companies cut labor costs, consumer spending weakens, companies protect margins by investing in more AI. The loop is deflationary for labor income and structurally inflationary for hard assets. You don't have to believe this scenario plays out in full to recognize that sophisticated investors are already pricing in the possibility. The capital flows are saying it plainly. Bitcoin fell below $64,000 today as leverage liquidations accelerated. In that same window, gold added over $500 billion to its market cap in a single hour. Silver added approximately $130 billion in the same time frame. When paper assets, equities, crypto are under pressure and hard assets are simultaneously surging, you are watching a live capital allocation decision being made at massive scale. This is not a coincidence. This is portfolio rebalancing in real time. Chinese capital flows and the gold to silver ratio. One data point that rarely gets the attention it deserves in Western financial media. Chinese investors have been buying gold ETFs at a pace that the World Gold Council itself described as historic. Chinese gold ETF holdings rose 52% between late August 2025 and the end of January 2026. That is not a rounding error. That is not retail noise. That is institutional and high net worth retail capital in the world's second largest economy making a deliberate, sustained, months-long allocation into gold during a period of elevated geopolitical uncertainty, domestic economic questions, and currency pressure. When Chinese capital moves into gold at this scale and pace, it matters for multiple reasons. First, the sheer volume of buying creates price support that is fundamentally independent of Western market dynamics. Second, it signals that sophisticated Eastern investors, who have a different set of information inputs and a different perspective on geopolitical risk, are making a clear judgment about asset class performance. Third, Chinese gold flows historically tend to be sustained rather than speculative. When Chinese institutions and retail investors adopt a positioning stance, they don't typically exit quickly. Now look at what this means for silver through the lens of the gold to silver ratio. The GSR, the number of ounces of silver it takes to buy 1 ounce of gold, spent most of the past decade fluctuating between 80 and 100. At a GSR of 80, silver was considered undervalued relative to gold by historical standards. At 100, it was extremely undervalued. For years, that extreme undervaluation simply persisted because the paper market could suppress silver pricing without the same scrutiny applied to gold. Then, on January 26th, silver spiked to $120. In that moment, the GSR compressed to 44 to 1. From 100 down to 44, that's a compression of over 55 points in the ratio, meaning silver outperformed gold dramatically in that window. The ratio has since stabilized in the 60 range. But here's what that tells you. Silver is no longer the chronic underperformer it was for most of the past decade. The GSR in the 60s represents silver still undervalued relative to gold by most historical frameworks, but the era of extreme, persistent suppression appears to be under structural challenge. The question is whether this is a temporary normalization or the beginning of a sustained reversion toward historical ratio levels in the 40s or even 30s. If gold continues to hold above $5,000 and silver continues to demonstrate the kind of resilience we're seeing right now, the math of ratio reversion alone represents a significant tailwind for silver prices going forward. The honest case for caution. Now let's be completely straight about the risks, because this channel has always given you both sides. First, the volatility point cuts both ways hard. The COMEX implied volatility index breaking above 100 means the options market is pricing in violent moves in either direction. A spike in implied volatility is not a directional signal. It is a magnitude signal. The market is telling you something large is coming. It is not telling you which way. Anyone who tells you that high silver volatility is purely a bullish indicator is selectively reading the signal. Second, coordinated institutional responses are real. Large positioning players, whether that's bullion banks, commodity trading houses, or sovereign entities, have the capacity to temporarily overwhelm physical demand signals with paper selling. We've seen this happen in previous silver bull markets. The physical thesis was correct. The timing of when paper price would reflect that thesis was not. Corrections in structurally bullish commodities can be sharp, fast, and painful for leveraged longs. Third, the Shanghai reopening could disappoint in the short term. Chinese institutions are sophisticated. When they come back from holiday and see a significant price gap, they don't necessarily chase it. They assess. They may decide the gap needs to be digested before further positioning. A measured response tonight, rather than aggressive buying, could result in near-term price softening even as the fundamental picture remains intact. Fourth, Mexico. It bears repeating, the supply disruption risk is real and directionally concerning, but it has not yet shown up in confirmed mine output data. Risk and confirmed impact are different things. The market can, and often does, trade on confirmed data rather than risk scenarios. Until we see actual mine output numbers showing a decline attributable to cartel disruption, this remains a risk factor, an important one, but not yet a confirmed supply shock. Fifth, timing. Mark Douglas spent a career explaining this clearly. Even the best fundamental setup can lose. The edge in markets isn't about being right on any single trade. It's about playing probabilities over time. The structural case for silver may be as strong as it's been all cycle, but when exactly paper price catches up to physical fundamentals is always the unknown. Anyone giving you a specific date or price target with high confidence is guessing, not analyzing. The responsible summary is this: strong thesis, real risks, uncertain timing, position accordingly. What to watch in the next 24 to 48 hours. Given everything laid out above, here are the specific data points and events worth tracking closely over the next 2 trading sessions. Shanghai Open. Tonight, the most immediate catalyst. Watch the opening price on SHFE silver futures relative to where Western markets are trading. Watch the first hour of volume. Watch whether the large short position triggers any visible forced covering in the early session. If Shanghai opens strong and holds, that is a significant confirmation signal. If it opens cautiously and trades sideways, it may indicate Chinese institutions are waiting for more data before committing. Hourly body close on Western silver above $89 is covered in the technical section. A confirmed hourly body close above $89, not a wick, a body close, would be the first technical confirmation that the resistance zone has been cleared. Watch this specifically. COMEX warehouse data. The daily COMEX warehouse reports show inventory changes with a 1-day lag. Continue watching the drain rate. If 2+ million ounces per day continues to flow out of COMEX warehouses, the inventory compression story remains intact. If withdrawals slow, it may indicate some of the short-term delivery pressure is easing. March open interest into first notice day. Watch how quickly March open interest declines over the next 3 trading sessions. A rapid decline means shorts are rolling or closing without forcing delivery. A slow decline means more delivery demands are building. The ratio of roll versus deliver will be a key signal for whether the paper market is successfully managing this expiration or whether forced delivery mechanics are going to add to physical demand. Macro headlines. Watch for any escalation in the US-EU tariff dispute. Watch for any development in the Iran situation. Watch for any further AI-related market disruption, particularly any announcements from major tech companies about workforce restructuring tied to AI adoption. These are all macro inputs that feed directly into the capital rotation thesis, favoring hard assets. 2 distinct forces are converging on the silver market simultaneously. That convergence is what makes this moment unusual. The first force is physical, a silver market that is structurally tighter than its paper price reflects. 5 years of supply deficits. Peak production in 2016 with no return to that level before 2030. Industrial demand growing faster than supply can respond. COMEX delivery demands active and running. Warehouse inventory draining at pace. A naked short on the Shanghai exchange larger than exchange inventory, with the exchange reopening tonight into a significant price gap. Mexico supply risk that is real even if not yet confirmed. The second force is macro, a global environment that is actively hostile to paper assets and structurally favorable to hard ones. Escalating trade tensions between the world's largest economies. Unresolved geopolitical pressure in the Middle East. AI-driven labor displacement creating deflationary pressure on wage income and upward pressure on fiscal deficits. Capital rotating visibly out of equities and crypto and into gold and silver in real time. Chinese institutional capital flowing into gold at historic rates. The gold to silver ratio normalizing away from the extreme suppression of the past decade. Both forces are pointing in the same direction. The open question is not whether the structural case is sound, the data supports it. The open question is whether tonight's Shanghai Open confirms what the physical market is already pricing in, and whether the technical picture resolves with that decisive body close above $89 that turns resistance into support. That data will be available in a matter of hours. Watch it yourself. Verify everything. The CME reports, the World Gold Council data, the Silver Institute supply-demand figures, all of it is publicly available, all of it is verifiable. This is financial warfare education, not advice, not a signal, not a recommendation. You are responsible for your own capital. Protect it. Do your own homework. Don't take my word for any of this, but do watch tonight. Because moments like this, when physical reality and paper pricing are this far apart, when multiple pressure sources are converging simultaneously, when the options market is pricing in violent moves and the physical market is draining in real time, these moments don't come around often. Watch closely. Phil AG out. This content is for educational purposes only. Nothing in this video constitutes financial advice, investment advice, or a recommendation to buy or sell any asset. Always conduct your own research and consult a qualified financial professional before making investment decisions.